All right, well, I think let's get started. Thank you, everyone, for joining us today for the first leasing webinar that we've done of 2020. It's a very pivotal time for all of us right now, and there's a lot of uncertainty surrounding the end of JobKeeper and what that means in terms of the mandatory code of conduct and your lease. So my name is Rebecca Galter. I'm the Director of Marketing and Events at the National Retail Association. The National Retail Association exists to support, inform and protect our members and the retail industry as a whole. And that's a major part of why we entered into this partnership with retail leasing and tenancy experts, Lpc Cresa. They're one of Australia's leading tenant-side only advisory services. That means they exclusively work for the tenant. And for NRA members, they provide some complimentary hotline advice and reduced rates on services. So it's really a great pleasure being able to work with Lpc Cresa, particularly through the uncertainty of the past year, to try and provide the best outcomes for our members. So what I'm going to do is hand over to John Reid, the Chair of Lpc Cresa, and we'll get started on the content of today's webinar.
Thank you, Meg. Thanks for that introduction. So the first, and hello to everybody, the first slide positions a project that we've been working on together with the NRA. And the project is aimed at the members and particularly in particular the smaller members. And it's to make leasing advice for tenants affordable and accessible. And so what you have in front of you is you have a picture of an online subscription plan, which will be launched in April. And as I said, it's to make leasing advice for the tenants affordable and accessible. More of that to come in the weeks to come. Next slide, please, Beck. These are your three presenters today. It's myself. I'll set the scene, and the way I'll set the scene is speak about JobKeeper coming to an end, the pandemic. I hesitate to say coming to an end, but clearly there is a sense of optimism related to the vaccine and other external factors. So I'll set the scene in relation to tenancy in this context, and then Carl, who heads up the LPC retail space for our ANZ operation, will take over and deal with some of the legislation, the technical aspects, and the difficult challenges that are being faced by retail tenants at this particular point in time. And then Carl will hand over to Dylan, and Dylan will have take it back to you are where you are and how do you enter into negotiations, even though lease expiry might not be due, or even though you might be in a situation where an agreement has been struck. But looking at your business going forward, there may well be a need for some added assistance from the landlord and some changes in the tenancy arrangements. So that positions the contribution of each of us, and then we'll hand back to Beck, who will coordinate a frequently asked questions or a Q&A session. So please send those through to Beck whilst we're speaking. Next slide, please. So in setting the scene, it's useful to look back in the first instance, and in the yellow block is what I'm speaking to currently, to look back and say, what is the impact of the pandemic? What has changed? What new thinking is being required of tenants and landlords, for that matter, as one considers the impacts and going forward from the pandemic? Those two statements are very important when one considers the retail tenant, very important for the mindset of the tenant. You don't get the lease you deserve, you get the lease you negotiate. And at the end of the day, it's just a reminder that the lease is a negotiated outcome, a negotiation between the tenant and the landlord and their various representatives, if that's applicable. The second statement is specifically about the pandemic, and it says COVID-19 has merely added to the already complex relationship between landlords and tenants. It's an astute insight from the Australian Retail Outlook, and that already complex relationship has got now another layer on it, and that layer is the impact of the pandemic and the recovery that's required. Now, on the right-hand slide, where it says COVID-19, how have retail tenants been impacted? It's a summary of the impact. So number one, retail tenants, we're closed due to COVID-19, have experienced limited and restricted utilization of their leased premises during the pandemic, and we're all well aware of that. Number two, many but not all retail tenants have experienced economic hardship. And again, we're aware of that, and we know the government response has focused on economic hardship in terms of the directives from the government or the guidelines and the principles for changes to leasing arrangements. All of that together really makes the point that your lease does matter going forward. Occupancy cost ratios in many instances have doubled in terms of the occupancy cost to revenue, and the lease really matters going forward. Next slide, please. And so from here, we look ahead. That's looking back, and we're looking ahead. And the question we're posing is, what then do retail tenants need as one looks ahead? And there's two things that's required. The one is interim rent relief, and the interim is a questionable word in the circumstances, because now we are looking ahead to recovery, and we're trying to reset leases and premises. And so interim rental relief, which has been much appreciated where it has been granted by the landlords to tenants, is interim rent relief really gives way to more structural changes, the need for structural changes in lease agreements. Now, that diagram that you have in those two graphical representations, the source of that is Inside Retail, the Australian Retail Outlook 2021, and that powered by KPMG. And all we want to highlight by referring to this is that the context in which leases need to be reset and the arrangements between landlords and tenants need to be reset for the good of the economy and the good of the individual businesses, and ultimately for the good of the tenant and the landlord. The context is somewhat difficult. And so two questions from this survey we need to highlight. Do you think relationships between landlords and retailers are more strained as a result of the coronavirus? Over 80% of respondents say yes, there's this added level of complexity and challenge. The other question, how do you expect leasing terms to change this year? And remarkably, almost 90% say no change or hardly any change expected. And so there's this expectation that the things will, that the framework for changes in leasing arrangements is fairly rigid and the changes will be minimal. That would be very unfortunate if that's the case. So your lease really matters. Next slide, please. Now, what this slide is going is, it's, as Beck said up front, is we represent tenants, and it's important for us to think from the tenant perspective. And this slide is highlighting the two blocks in the top, is highlighting a mindset, if you like, for pre-COVID-19, and then a mindset for pre-COVID, for post-COVID-19. A way to think about that is the ink is dry in terms of a lease arrangement pre-COVID, and in some ways the ink is not dry. Now, we're using extremes to communicate a message here, but the government intervention essentially intervened and created a context in which the ink is not dry, the need for negotiation, the need for landlord and tenants to speak to each other. The second principle is pre-COVID, lessee beware, and the principle that's come out and the government has contributed to that is looking ahead is a principle of lessor to share in the risks of the business and share in the challenges and the rewards, the risks and the rewards going forward. This is an important principle to recover from where we're at currently in the retail sector. The third is legal resolution. There's a dispute, there's something to be resolved between tenant and landlord. And in some senses, the pandemic has created a context in which there's negotiated resolution. And so if you hold that framework in mind, Carl and Dylan will come back to that framework and make it practical for what they speak to. Now, we at Lpc Cresa, our aim representing tenants is to try, as that barometer indicates, to try and help the balance between landlord and tenant, or occupier shift over time, so that the occupier's business has got more chance of doing well or surviving, for that matter, into the future. And those are the 5 headings that we focus on when we look at individual terms. Next slide, please. So my last slide is this slide, and my slide is asking the question. So with that change in context, as I've summarized it very briefly, what are some of the key things that retail tenants can do? And Carl and Dylan will pick up on these points. The first one is, remember, the ink is not dry. We're using that as a bit of an exaggeration, but the importance to use this time to actually go back and talk and speak to one's landlord. It's a very unusual time. Probably none of us have experienced this before. The need to talk to each other and to get through this time and to reset and recover. The second is keep asking. Keep on asking your landlord as a tenant. Keep asking your landlord. Don't talk to the landlord. Don't think that things are done and dusted. The third is very important, and it was brought out through the government, the mandatory code of conduct, is when you're interacting with the landlord, present the facts about the business outlook for your business going forward, and present the facts to have a reasonable discussion and see what changes can be made to structural arrangements going forward. Request the deferrals. Many retailers are coming out of this arrangement not well off, and the acceptance of deferred rental is going to be something which many cannot cope with, and in many instances it will be a burden that will lead to closure. So the issue there, which Carl and Dylan will revisit, is you need to talk to your landlords about that. Request turnover rent and request the landlord to share. Enough from me. With that, I hand over to Carl. Thanks, Carl.
Yeah, thanks, John. And the next slide there, Beck, where I'll start off. What a great introduction to the section that Dylan and myself will cover off. Real looking back and looking forward and sharing of, I guess, the fundamental principles that we apply to these processes. Hopefully many of you sat in on the webinars last year, so my section certainly will essentially be some revision of concepts and suggestions that we put forward last year around negotiating rent relief under the legislation which gave effect to the code. What we're experiencing now, really, and reverting back to last year, there was a lot of talk about the cliff and how there'd be a cliff and lots of businesses would suddenly close and the economy would fall apart once JobKeeper ended. And in all honesty, for some categories, some sectors within retail, that's a very real possibility in the next quarter. And we what we're sharing now, I guess, is hopefully a bit of a roadmap for how to avoid that cliff. So the questions that we're experiencing right now is that on the left-hand side there, I've managed to keep going through COVID with the help of mandatory code of conduct and JobKeeper, but now these protections are ending. I need long-term changes to my lease terms and occupancy costs in order to survive. We might just flick straight onto the next slide, Beck, and I'll talk to that. You may recall these images from past webinars where social distancing has been employed in order to continue business and make the most of the opportunity to be open. Unfortunately, in many categories of retail, there are things that have been put in place to mitigate the risk of the actual virus, which continue to impact on retail trade. Things that are related to travel and tourism, restaurant and catering sector, for example, as well, particularly in CBD areas, which are impacted by workers not quite returning to offices and things like that. So where businesses remain viable through COVID due to the rent reductions, and now that's all coming to end, how do they stay viable going forward? We want to stay focused on the two boxes up above that John spoke to, where in the past, and certainly landlords still believe that once you've signed a lease, that's it. The ink is dry and there's come back in 5 years' time. Well, really, COVID has shown us that the ink is definitely not dry. There's always the opportunity to negotiate variation to the terms of the lease during the term of the lease, and that was a mandated position during COVID, and certainly an opportunity continuing going forward, particularly where landlords are motivated to ensure continuity of their tenants' business for their long-term benefit. So there's clearly a need for tenants now, and I would assume that if you're on this webinar, that you're in that position where you would very much like to or need to negotiate better commercial terms for the remainder of your existing lease term with, or at least some interim period with your landlord. We'll flick on to the next slide, Beck, where I've got, on to the next one. That's the pictures I was just talking to. And we're talking to the deferred rent versus deferred paying. This was the concept that we covered last year. And when COVID first started to impact and the code came out, allowing landlords to defer a component of your rent and to waive a component, the advice was most certainly to avoid the deferred rent, because that would result in significant pain later on. Landlords resisted that very strongly, and so later in the process we started to refer to the deferred rent as an opportunity and some leverage later on. If we couldn't avoid it, then we would try to turn it around and use it as leverage later on. And that's where that comes into play now, where deferred rent has kicked in, JobKeeper is ending, other support systems have faded out, and even the legislation has ended in every state or is about to. The deferred rent is still in place, and for many of you, turnover hasn't returned to full pre-COVID levels. So it's certainly resulting in some pain from now going forward. And the desire is to change your lease arrangements so that that deferred rent is dealt with in some way. So the opportunity to do that is to leverage it against things like lease extension or lease renewal if you have that coming up. Many landlords would be motivated to extend your lease term by 1, 2 or a whole new lease term of 5 years. And we are having success in having the deferred rent component waived as a part of the incentive involved in that benefit to the landlord. That's one way of dealing with deferred rent. In other cases, we're able to negotiate the deferred rent being paid over a much longer term rather than the 2-year term that was indicated in the code. Or we're able to defer the commencement of it until certain conditions happen. And this sort of links to the concept that the yellow part there, legislative protections have ended, but the code remains in place. So the mandatory code of conduct, the legislation gave effect to the code essentially. While the legislation has expired or been repealed, in some states on December 31 and some it's ending next week or in April. But the code itself remains in place. And I've had conversations with the Small Business Commissioner on this point particularly. And most certainly the code was always, it was connected to the JobKeeper. And so certainly until the end of JobKeeper, there's no doubt that the code remains in place. But then there's other factors that are quite grey and difficult to define exactly around when the code itself and the mandatory code, the principles that apply to that, actually how long that remains in place for when it ends. There's a big component of the code that refers to the reasonable recovery period. And the reasonable recovery period is given credibility in a New South Wales legal case where the judge indicated that the reasonable recovery period would extend for at least 6 months beyond the pandemic period. And therefore, one would assume that the code was in effect for that period as well. So what's not defined is the pandemic period. The pandemic response period was linked to JobKeeper and the legislation, but the pandemic is clearly still impacting on business. And the reasonable recovery period after that, in our view, would be linked to the actions taken by the government that are still impacting on businesses, which were put in place to mitigate the risk from the virus. So things like travel bans, international tourism not returning, limitations on the number of people allowed in confined spaces and things like that. So our view is that the code remains in place while those things remain in place. The key principles are really what we need to remain focused on and apply to negotiations with landlords now. Negotiations around deferred rent, negotiations around returning to full trading hours, negotiations around repayment of rental arrears accrued during the period since the start of the pandemic. It's our view, and that view is shared by the Small Business Commissioner, certainly here in Queensland, that the landlord should be adhering to the principles of the code and things like not issuing default notices on rental arrears or default notices on not opening for late trade and things like that. So that, keep in mind the code, it's our advice that negotiations can certainly be conducted around the leasing principles of the code and will continue to do so. Beyond that, the key principle of the code and the reason for it being was to ensure continuity of business. And there's still a risk to landlords that businesses will close as a result of COVID and these limitations on businesses. So even base rent reductions under the code can still be negotiated now. We definitely see variation of terms of repayments and variations of lease, base rent and things like that are still able to be negotiated now, not strictly under the code, but as a result of both landlord and tenant wanting to remain viable and sustainable through the lease term. The key point to that is this bottom point here. The landlord should be seen as your partner rather than adversary at this point. And if the landlord sees it that way, they'll certainly be more open to those negotiations. There's a number of different forms that lease variations can take, and Dylan's going to pick up on certain motivations of different types of landlords and what variations to your lease structures, your lease, base rent or turnover rent or things like that may be agreeable to the landlord based on some different factors that you might cover off in the next little section. So in terms of the code and any negotiations around that, the reasonable recovery period, it should be KPI related rather than time related. So at the time that your turnover returns to pre-COVID conditions, or when international tourism returns to Australia, they're KPIs and they're measurable, not just 6 months from now, because on the 1st of April last year, everyone expected the pandemic to be done and dusted and finished in 6 months. And that's why the pandemic response period was set up for that time frame. So clearly, you need to focus on KPIs and key actions that will return your business to normal. So if I could just get back to go to the next slide, and I'll hand over to Dylan to talk through some of those concepts.
Thanks, Kyle. So, yeah, as Kyle mentioned, next I'll be looking at a situation where a business has perhaps been successful in negotiating rent relief, but as that rent relief is now ending, revenue hasn't returned to pre-COVID levels and sitting at quite an unsustainable level, and there may be an opportunity to reset the lease in the short and longer term. So this situation is actually becoming quite common, and first of all, in addressing it, I want to start by really stating the obvious that some of these conversations with landlords aren't easy. There's some precedents of landlords accepting some of the initiatives we're speaking about today, such as variable or turnover rent in high street locations, but I wouldn't say there's anything like widespread industry acceptance, certainly not to the extent needed for these types of conversations and negotiations to be easier at an individual business level. So if we go to the next slide, thank you. We can see by this slide and these statistics just how difficult the task is. So this tells us that less than 4 in 10 landlords were more willing to reduce rents in 2020 than previous years, and that's even when rent relief was legislated. So I've represented plenty of businesses in the last 12 months where these statistics really played out. I think we know that a lot of landlords dug their heels in. We know that going forward, any discussion with an owner that's potentially going to impact on their monthly income or potentially reduce the capital value of their investment is going to be tough. It's going to be a tough conversation to have. So what we want to leave you with today is a suggested approach for working through a negotiation with your landlord and ultimately getting to a solution that both you and your landlord can live with. So if we go to the next slide. So first of all, I can't stress enough the importance of being clear in your own mind about what problem it is that you're trying to solve for your business and what outcome it is you need to achieve to return to a sustainable footing. So, consider, is it a short-term challenge that you're trying to overcome, something that you can demonstrate is directly linked to COVID, but you're confident once overcome can be put behind you. So as some of those factors that Kyle just spoke about return, some of those KPI measurable factors return to a certain level that you're confident your business will return to, or are you trying to solve a more structural long-term problem that was around before COVID that's now accelerated, such as declining pedestrian traffic, increased shop vacancies in your neighbourhood, which may have been occurring pre-COVID but has really been accelerated. or are there any other factors that have been impacting your ability to trade at a sustainable level over a longer period of time? So in addition to your revenue figures, do you have pedestrian count figures, local vacancy rates, anything that might support your case for change? So if not, you can refer to data that is produced by your local council, talk to your neighbours, walk the street or the centre, get a feel for how many vacancies there are, how many short-term leases, pop-up shops have replaced more permanent retailers, and really tap into the NRA resources, the information they publish that will be available shortly through our online subscription service, and use that to help you work out what a sustainable occupancy cost level is for your business type. So whether you're in food and beverage, fashion, whatever your particular retail sector is. And once it's clear in your own mind about what you want to achieve with your landlord and what you'll be seeking from your landlords, next really worth investing the time in understanding your landlord a bit more and perhaps what they're trying to achieve also. So if you think about approaching your landlord in a similar way to how you'd approach another potential business partner or investor, you're essentially presenting them with a business case to consider. And when presenting a business case, knowing your audience and what they'd like to achieve is probably your number one priority, and this is really no different. So approach any lease negotiation in that way. So to do that, you really need to consider, is your landlord a small family investor? Is the property providing them with monthly income in retirement, for example? Or is your landlord a bit more sophisticated as an investor, maybe a private investor with a portfolio of properties, or maybe even an institutional investor? So why that profile matters is that the first type of landlord is likely to be heavily reliant on a rent payment coming in each month, and particularly if there's no mortgage attached to the property, maybe less concerned with protecting the capital value of that property. The second type of landlord might be open to more short-term impacts to their income if they can achieve something that protects the capital value of their investment in the longer term. So, every landlord's circumstance is going to be different, as will the goals for their retail investment. If you get to know them a little bit more, you can begin to form some educated assumptions around what their goals might be and shape your business case or your approach to any negotiation accordingly. I will just say you're probably not likely to get this information from an agent. Where possible, you're probably going to have a conversation directly with your landlord to understand a bit more about their circumstances if it isn't immediately obvious or known to you. But what I will say is that whatever your landlord's profile or their circumstances, the main threats to their investment and their ability to earn an income will be, high vacancy rates in the neighbourhood or their centre, declining pedestrian traffic, slow demand for retail space. So, keep in mind that if those circumstances apply to your local market context, think about how you might be able to use that to frame a negotiation. Finally, once you've clarified your problem, taken steps to get to know your landlord, next step is really to consider how you might approach the negotiation. And this is where a well thought out, constructed plan will help you to approach a landlord with a proposal that might work for both of you. So to give yourself the best chance of success, I'd be planning to present a clear picture of your circumstances, backed up by some evidence that we've already spoken about, some of the measures you've already taken to adapt your business and some of the things you'll be doing to continue to adapt. I'd then be presenting some pretty cold, hard facts about your retail environment, how that's likely to impact on your ability to trade and for their ability to continue to earn an income from the property in the short term, or even, maintain the value of their investment in the longer term. So there are so many ways you can approach the negotiation if you know the levers that will make a difference for both you and your landlord. We've already touched on the level of rent, and that's obvious. But instead of simply asking for a reduced rent, can you demonstrate there's a way the landlord can get a higher income from the property in future if they work with you in the short term? And, where we've seen this work and where it can work is is if you can show your occupancy cost ratio has historically tracked at, say, 12%, but it's currently at an unsustainable 25 or 30%, can you propose that in return for some rent relief, you'd be prepared to give the owner some future upside if and when trading returns, but for your part, perhaps you're prepared to lock in an occupancy cost ratio of 15 or 17%, whatever the number is that you think you can sustain, but can give the landlord some future upside. Length of lease term, also an obvious lever. We've spoken about that already. Can you commit to a longer term as a trade-off for short-term rent relief or other concessions? Removal of rent increases, make good reinstatement clauses. Some of these expensive items tend to be hidden in leases. Is there investment in the fit out that landlord can contribute to that would have a positive impact to your revenue and help you attract more customers? So if you know all the levers that you have at your disposal to frame a negotiation, then you can present some alternatives for you and your landlord to work through and come up with a solution that you can both live with. So obviously you're not going to necessarily get everything you're after, but if you go into any discussions being fully prepared, you can make some informed decisions along the way as to what you might be willing to compromise on or concede to improve your overall position. I think the important thing is when you're meeting with your landlord, even if there's no upcoming lease expiry, and approaching it in a way where it is more of a partnership conversation, that you're really planting the seeds of how you might be better business partners rather than just parties to a highly contractual landlord-tenant relationship that we've referred to. So I think I'll leave it there, and we've got some questions. So thank you.
Amazing. Well, thank you so much, everyone, for going through that. If anyone has previously attended our weekly health checks we did during the height of the pandemic, you'll know that this is now the time to put your questions down, either in the chat or in the Q&A box. This is a really unique opportunity for you to get advice about your business and how to do these negotiations. Because as the theme of today's webinar has been, your lease matters. So our first question comes from Jules. I find landlords are unwilling to negotiate as it's a tax deduction for them. Is there any way around this?
I can kick off because I followed the trail, and thanks for the question, Jules. And so I think the question that I would have the least contribution to make would probably be the tax one. That's an interesting, I don't quite follow the gist of the question, because if there was a renegotiation, they would have reduced income and they would have costs. So potentially there would be an argument that therefore the landlord would be, unless I'm missing the question, would be due to pay less tax because you'd have less income with a renegotiated arrangement and costs. But I might be missing some of the essence of that question. But I think if I can go back to the initial question that was asked, which was the idea, the concept, interesting concept, the idea of sort of mandating a reduction in retail rentals, some sort of edict, legislative framework based on the, let's call it the protracted vacancies or the increased vacancy. So if I turn that around and say the purpose, as I understand that, is, so first of all, very interesting idea. The purpose of it is to try and drive a pragmatic, realistic response to a very significant business challenge, a very significant macroeconomic challenge, and that is to have a shift in the nature of tenancy arrangements. And the suggestion is some sort of legislative framework. I mean, realistically, we're working in a supply-demand economy, not a central, centrally controlled economy. Even the mandatory code of conduct gave principles with a light legislative framework to back up the principles. And so I think realistically, one has to say supply and demand is going to be the framework. Now, what would I say on that? The point that I would make is this type of forum and the likes of the relationship between tenants and the National Retail Association and the likes of ourselves who work on the demand side, advocate for tenants, is there's a great need to increase advocacy on behalf of the tenant. And, landlords are very well organized. For every one landlord, there's 1,000 tenants. So who can organize easier? It's the landlords. It really is important to increase advocacy and to make advice that helps the tenants generally more affordable, more accessible, to have an overall impact on the let's say the occupancy cost across the sector.
Thank you, John. Our next question is from Barbara. We are up for a lease renewal and the landlord has proposed a 10% increase on our current rates with 5% per year. Do you have any suggestions to help with negotiating with a shopping centre landlord?
Kyle, did you want to take that one? Or?
I was looking for any hands up. I'll jump in, then you can add, Dylan, from your experiences as well. Look, firstly, just quickly on the annual increases, we mentioned 5% increases. Westfields will not budge on their CPI plus 2.5%, but at the moment that's around 3 to 3.5% annual increases. So it's within the realms of where we would like increases to be at CPI or 3% based on the economy right now. To ask for a 5% annual increase just is not in line with what's happening in the economy. And certainly we represent some national retailers where if we presented a heads of agreement to their board with 5% increases, they would kick us out of the room and probably not engage us to do that work for them anymore. It's not in line. So at the very worst, we would be agreeing to 4% increases if other commercial terms were very good. In terms of a 10% increase on your passing rent, your current rent, there must be some specific situation resulting from that. The sad thing is that in big shopping centres like that, they have access to your turnover, and they have in their mind what occupancy cost ratio they believe you should be able to operate at, and in many cases it's in excess of 20%, which we would consider putting the tenant into a position of financial distress. So what the landlord sees as viable and sustainable for a tenant, and what we certainly believe is viable and sustainable, and what tenants feel is sadly a fair way apart in many cases. So the key thing for us is that we don't buy into landlords' recommended retail prices, the price they want because they happen to have a budget or they happen to want to return to shareholders a certain amount. We remain focused on what's viable for the tenant as a percentage of your forecast turnover. And when you've been operating in the business in that centre for at least one lease cycle, you should have a fair idea of what sort of turnover you're going to do in the next cycle. Both during this impacted period and hopefully when things do return to more normal trading conditions. And you need to stick to the percentage of turnover that your business can survive on and be profitable on. And as some very smart retailers say, they're not in the business of working extremely hard for no profit. Just to generate income for a landlord. So at the end of the day, if you need to walk away from that shopping centre, you need to walk away, and that's often you will not get the best terms available to you until you're prepared to walk away. So without giving you a specific step-by-step process to follow, that's just a couple of points around what we are facing here in these sorts of centres. But 10% must be based on something. We would need to understand where that's coming from, why they're proposing that, and present a compelling case as to why the counter offer we're proposing should be accepted.
Thank you, Kyle. I think we only have time for one final question. So if you do have any further questions, please feel free to email us. This question comes from Tony. How do you determine the OCR?
Simple and quick. Occupancy cost ratio. It's add up your occupancy costs. If you're in a shopping centre, essentially your base rent, outgoings and marketing levy, and calculate that as a percentage of your gross turnover for the year. In some businesses, like the restaurant and catering business, they will include all occupancy costs, which will inflate the occupancy cost ratio, obviously, as a percentage of the turnover. But the occupancy cost ratio that most landlords will be aware of only involves what they get paid by you, which is rent, outgoings, marketing levy.
Beck, may I just say, I realise our time is gone, but can I just say something extra to who was the question in relation to the shopping centre? Barbara, was it?
Yes.
Yes, okay. So excellent question, Barbara. And in addition to what Carl said there, I would refer to that one slide, that last slide that Dylan covered. Unfortunately, we can't go into too much detail, but that's a very good slide for giving a framework for how to respond. That's as difficult a situation as you can get. Shopping centre landlords are very consolidated, and as tough as you can get. But there is an answer, and I think what Dylan was highlighting was the importance for the tenants of being very clear about the problem and articulating it with evidence, the problem they're facing, but also being clear about the vision going future and what is required in terms of changes between the tenancy arrangement between landlord and tenant. And also try and speak to those who are actually capable of modifying arrangements and so on. Try and get to that sort of level as much as one can. But that's a difficult question. But it's very, very that is probably the question of the moment. I would say, the way you've expressed it.
Thank you for adding that on, John. Really great, valuable information there. And thank you.
There's a whole series there from Jules and a couple of others around matters relating to landlord motivations for accepting lower rents or leaving tenancies vacant and so on. And maybe that's a future webinar just around landlord motivations, valuations, asset protection, base rents versus effective rents, and things like that are more detailed concepts that go into trying to present a compelling argument to a landlord without impacting their business significantly.
Absolutely. And as I said before, if any of our listeners have any further questions, more than happy to discuss those out of this webinar as well. Kyle, John and Dylan, thank you very much for your time this afternoon. I know that you've all been tremendously busy over the past 12 months, and it's always great to have you here sharing your experience and helping our retailers make the best decisions about their lease that they can. So thank you very much, and it was a pleasure to have you.
Thank you. Thank you, everybody.
Thanks, Beck. Good luck to everyone.
Thank you. All the best.
Thank you.
Thanks, everyone.